All right, so welcome to really what we're going to talk about jumbo home loan financing. A lot of questions we get because we are seeing guidelines change. So we're going to talk about sophisticated mortgage planning for affluent buyers, not just bigger loans, right? So here's my background. I'm born and raised in Northern California, lived throughout Hawaii and Southern California, 24 years being in this industry, top 1% of the country, luxury financing specialist. So we're going to go over a couple of areas of focus here: jumbo lending, complex income scenarios, portfolio lending, and what have you. So in today's room at this landscape, we're looking at the borrowing strategy, right? So the luxury market's changed. We know that today's luxury buyer doesn't look like yesterday's. Today's luxury buyer is often a business owner, executive, tech employee, right? We're seeing a lot of that, especially back in the Bay Area where I'm from in San Francisco and Oakland. A retiree investor, entrepreneur, an athlete, and have quite a few things here, right? So as we push on, what makes luxury lending different? Not bigger, more. It's just more complicated borrowers. Often is the case. Loan amounts rarely the hard part. It's usually the income asset structure where the complexity lives. So luxury lending is fundamentally a documentation and strategy challenge, not a size challenge. So luxury borrower, common income sources, usually multiple large asset holdings, trust income, RSUs, especially again with tech, bonus compensation, restricted stock, business ownership, portfolios. So understanding jumbo loans is really understanding the loan for a jumbo loan basically exceeds conforming loan limits. So there's different underwriting standards, greater reserve requirements, more extensive documentation. Now, not every loan will fit the Fannie Mae, Freddie Mac underwriting guidelines. So we have portfolio lenders and investors, which means that they'll keep the loan rather than sell it, creating underwriting flexibility and often better pricing, right? They think about the bar, not just a checklist. So relationship banking would be private banking relationships, asset-based lending, cross-collateralization, and securities-backed lending. Now, income is always salary. It could be bonus, commission, K1, dividends, restricted stock, trust distribution, royalties, business income. There's a lot of different things where income can come from. Now, keep in mind, business owners, underwriting can review tax returns, write-offs, cash flow, bank statements, profit and loss statements. Are going to want to get documentation from your CPA as well. Common compensation structure that we see is a base salary for executives with bonus, deferred compensation, RSU, stock options, right? Golden handcuffs, vesting schedules, right? So we look at tech employees, right? We call it the Silicon Valley style compensation, also all throughout the Pacific Northwest now and throughout other states as well. But stock grants, vesting schedules, IPO wealth, restricted stock, right? We're going to look at a variety of things here. The fourth one is, of course, those that practice medicine, right? Often they're doctor loans. Actually, there are doctor loans, and often there a lot of the physicians we've worked with over the years are straight out of the residency, starting to work at a practice, and so they tend to have a strong future income potential, often high student loan debt, right? So it definitely is one of those structures that we can build for the specific client. So professional athletes, unique considerations here: short earning careers, highly variable income, signing bonuses, endorsement income, significant tax planning needs. A little bit different there as well. We've worked with quite a few over the years, and those are kind of in a box of its own, if you will. Retirees, common qualification paths would be using asset utilization. So the high net worth, right? Trust income, investment income, pensions, social security. Trust income, similar to retirees, but we'll look at distribution history, consistency of payments. We'll need to document that. Now, asset utilization. This is one of the least understood loan programs in the industry. Income is calculated from liquid assets instead of traditional documentation, especially useful for retirees, high net worth borrowers, and trust beneficiaries. It's a super powerful tool for asset-rich, high income or income light, should I say, borrowers. So private wealth borrowers. Common asset types would be brokerage accounts, cash reserves, family office structures, trusts, private equity holdings. Buying through trust would be common structure, revocable or irrevocable trust entity ownership. LLCs, common motivations to purchase through an LLC would be holding company structures, privacy, asset protection, and entity specific lending considerations. A luxury investment property. Often we see Airbnb, VRBO. We've seen them throughout Malibu. I see a lot in Palm Springs, vacation homes, second homes. We do DSCR loans, right? We're using income of the property, either short-term or long-term, to calculate that. Bridge financing. This is where you can sell a property before you buy a property. Another great scenario for a lot of folks. So You can avoid a contingent offer in a competitive market using a strategy such as this one. So the idea here is not about the payment, it's about the whole picture. We want to talk about mortgage planning with you. We're going to go over the monthly payment, opportunity cost capital, liquidity needs, expected investment returns, tax strategy. This is where mortgage planning becomes really wealth planning. It's incredibly important to go over budget needs, ROI for the entire asset picture. So this is the question we often get. Should you pay cash? Cash may make sense when winning competitive offers the top priority. No mortgage is a personal priority, regardless of the math, and investment alternatives don't clearly outperform the opportunity cost. Financing may make sense when keeping capital invested as more than an all-cash offer. Liquidity needs to remain flexible. Investment returns are expected to outperform the mortgage cost. So again, financing makes sense. Keeping investments invested and working, portfolio diversification, maintain liquidity, strategic use of leverage, tax planning considerations. So we're going to talk about interest rate strategy, which can be a fixed rate or adjustable rate mortgage. It's really up to the client how long they intend to hold the property. Are they going to pay off the loan? What's the game plan there, right? Fixed rate tends to be a 10, 15, or 30-year fixed. Now, adjustable rate mortgage tends to have a fixed rate period and adjust thereafter. So interest-only loans, this may be appropriate for cash flow. If cash flow is a priority, you can get an interest-only loan for often up to 10 years. Liquidity could stay high, and it fits a specific investment strategy. So we go through Mortgage Coach, go over each of these once you apply, making sure that we could go over cash purchase, fixed financing, and interest only. We like to coach you through this process and give you some real numbers so you can see the rate of return and what that investment looks like. What we talked about is building your advisory team, mortgage advisor. That'd be us as we guide you through this process. Your CPA or your tax advisor, a financial advisor, want to make sure we're in touch with them to be able to help go over everything in great detail. Your estate attorney and insurance and private banker. Common mistakes. These are things that we'd often advise anybody do, but don't over leverage. Don't ignore liquidity needs. Don't buy based on just the monthly payment. Don't wait too long to plan. Documentation does matter, and choosing the wrong lender for a complex scenario can be a hindrance. So here's some real examples. Executive, significant RSU and bonus income compensation. We had to get the vesting schedule. We had to look at most of their products. It didn't fit the traditional guidelines that were needed for a lot of our big bank scenarios that we work with on what we call a secondary market, meaning we'd close the transaction house and sell it. So we found portfolio investor, that's one of our investors, that was able to underwrite the transaction and close within a matter of 12 days. Incredible transaction. Business owner. We use a bank statement loan because they write off a lot of what they do through their business. We were able to coordinate this closely with their CPA, working hand in hand. And again, a 15-day close where they were able to get an incredibly aggressive rate and a great product and close in just a matter of 2 weeks. Retiree, asset rich was another transaction a couple years ago now. One that I'm thinking of for this scenario. He was retired, high net worth. He was able to capitalize on using asset utilization, was able to preserve the investment portfolio that the individual already had and purchased property in Marin County up in Novato. Great property, great closing. And this one we did actually, again, in about 14 days. So for agents out there, how we support your deals, winning competitive offers, fast approvals, fully underwritten before they even write an offer. We closed one last week, recording this on 21st of July, but in 7 days for a buyer who closed in Oakland Hills. Mortgage planning conversations, not just pre-approved letters, and creative financing structures when needed. For your builder, we support your projects. Luxury custom home construction financing, draw schedule management, bridge loans for transitions, and buyer financing coordination. Some questions we often get is, can you qualify with RSUs? Often, yes, but we have to look at the vesting history, how long you've been receiving RSU income, and look at program-specific documentation. Should you pick cash? It depends entirely on liquidity needs and opportunity costs, not just a universal answer. Can assets replace income? In many scenarios, yes, through asset utilization programs. Can trust an LLC borrow? Yes, often on non-owner occupied properties or investment properties. Sorry, guys. Why luxury clients choose our team? We bring genuine comfort with complex income. Our analysis for every scenario, broker plus direct lender flexibility, access to portfolio lenders, construction and jumbo expertise, private client first service. So the checklist, income documentation, asset documentation, a credit review, which we generally start with a soft to start for pre-qualification, liquidity assessment, CPA coordination, attorney coordination, and a defined mortgage strategy. Next steps are really reviewing your financial picture, comparing financing options, coordinate with your advisors, build a custom strategy built just for you. So if you have questions, my information is down below. Definitely shoot me a message. I'm here to help. There's my contact information. Schedule time to connect with me. Again, it's down in the captions. Looking forward to having a conversation with you soon.